The stock market is crashing, and this is when investors are truly tested. Will you act on emotions and make some truly dreaded mistakes? Or will you be reasonable here, be rational, and stay invested during these tough times? In this video, I'm going to be covering some common mistakes that I see being made during a market crash, like the one we're seeing right now here in 2020. And I just want to thank one of our subscribers, Scott, who suggested this video, and I thought this would be a great idea to share with you guys because we do need some sort of rationality here because there's tons of media outlets just throwing fear into the market. So we need to take a step back, look at it for what it is, and try to rationalize what's going on in the markets. Now, if you are standing strong during this volatile time here in the market, make sure to drop a like down below so that we can reach a wider audience here for this video and help other investors also think rationally. Share this with a friend, share this with family, share this with coworkers. Make sure that the word gets out there because we don't want people panic selling during times like this when they should actually be looking for opportunities right now to pick up great businesses at cheaper valuations. You will not believe how many times I hear people say or see people comment the same thing, which is, why don't you just sell now and buy back in later? You know, it's straightforward, it's simple, it's logical. If a stock's going down, sell it, wait for the bottom, buy at the bottom, and then just enjoy the gains. I know it sounds simple, but trust me, in practice, this does not work that simply. Now, if you're a short-term trader, I can kind of understand where this logic is coming from. Maybe you need the cash in the short term. Maybe you just want to cut your losses because it went lower than you expected. So you just want to cut that out, maybe take advantage of the downward move. I don't know, that's short-term trading for you. That's not something that I do. Me personally, I'm a long-term investor, and that's something I really try to advocate on this channel. And as a long-term investor, the worst thing you can do is to sell now and wait for the bottom. There's absolutely no guarantee that when you sell, the stock is actually going to continue moving lower. And ironically, more often than not, a lot of people will agree with this. And if you've been in the market for a while, you've probably experienced this yourself, that when you do end up selling is when the stock actually ends up bottoming. And then you have to buy back into the stock at a higher price if you choose to get back in. Or maybe you get lucky, you sell the stock and the stock continues dropping another 20% from that time period. Or maybe you get lucky, you sell the stock and the stock continues dropping another 20% from when you sold it. So great, now you look like a genius, you saved out on 20% losses, but when do you buy back in? So you're gonna wait for the bottom, you're gonna wait for the stock to show some sort of bottom, but you're not gonna buy back in there because it still could go lower. So you're gonna wait for some sort of recovery, but you're not gonna buy yet because you wanna make sure that this rally is sustained. And then once it starts rallying, that's when you start to buy back in. Now, more often than not, with this mentality, you're gonna most likely end up with the same cost basis as if you just held the stock during that time period. This is because psychologically, we're not designed to take on risk and buy things as they are lower or moving lower. Naturally, human instinct is gonna be, you see red, you sell. So say maybe you buy back in at a cheaper price than when you sold. It's still not going to be significantly lower in my opinion for most cases because like I said, that's not how the human mind works. And if you are selling when you're seeing red, there's a higher probability you're not going to be able to buy back in at the lows. But anyway, say you buy back in, you get a better cost basis, now you start riding the stock higher and you see the stock dip a little bit. And again, your mind goes back to the same thing. I see it dipping, I'm going to sell, I'm going to wait for a bottom, I'm going to buy back in. It dips, you sell, but now this time instead of going lower, we actually bottom and we start moving higher. And you missed out on those gains, and that's what happens when you try timing the market. Now, this is a slippery slope, and it's gonna lead to really bad habits in the market. It's something that I personally have gone through, guys. It's not just something that I'm preaching here because, you know, this is the best thing to do. I have personally done this, and I can give you a good example. Visa is a company that I used to own in my portfolio. As of today, I don't own Visa in my portfolio. However, with Visa, I actually held the stock. I bought it in the 2018 correction at around $120 something per share. I held it to around $150 per share. And then I saw a little bit of a dip. I felt the stock was overvalued. So I sold my position. What did Visa continue to do? It continued moving higher and higher and higher. I believe it hit over $200 per share, and now it's corrected, but it's still sitting at around $170, $180 per share, and I've missed out on that gain the whole time. I tried to time the market, and I got burned on this stock. And this isn't the only company I have an example for. There are many, many others, but that's the most recent and the most obvious one. Yes, in this case, I still made a good amount of gains with my original position, but had I looked at the long-term potential for this company and just ignored the short-term noise, I'd be up even more on my position right now, even after this big correction. And really, I'd have to ask you, if you do try to time, sell, and buy at a lower price, what's the end goal? And really, when I think about it, the logic behind this is so flawed. You sell the stock, you watch it go lower, you watch it recover, and then you start buying back in. You just add this extra layer of complexity, trading, and really stress, in my opinion, because now you're gonna have to keep a close eye on this, make sure you enter back in at the right price, all this kind of stuff, when you could have just held onto the stock. Maybe you miss out on a few gains, but it is what it is, and you don't really have to worry about getting back into the stock at the right price. There's a reason why great investors like Warren Buffett just buy stocks and hold them for the long term. They don't try to time when they should sell and buy back in at the bottom. They just buy and hold, and if stock drops lower, they'll just continue averaging in and lower their cost basis. That, in my opinion, is a strategy that is the best for long-term investors. It's what I personally use, and I've personally seen a lot of success using this, which is why I'll continue using this moving forward. So next time you're considering selling out and waiting for the bottom, just ask yourself, you have people like Buffett, like I mentioned, with over $100 billion in cash, access to pretty much any resource he wants. He can get the best traders in the world working for him, but he still chooses not to do that. There's a reason why, and the reason is because over the long term, you usually miss out on big gains by trying to time the market. So this is another common one that I see, which kind of ties in with the first mistake, and this is very obvious during volatile times. Some so-called investors, even long-term investors, can barely see their stock portfolio down 1% or 2%, let alone 10% or 20%. So when that does happen, they just hit that sell button, they lock in their losses, and chances are they're probably never going to come back to investing. Seeing red in your portfolio is scary, even for myself. Been in the market for a little while now. Seeing red isn't the best feeling, but it is something that you have to control. You got to control those emotions, and don't let your decisions be based on those emotions. And I see so many comments on my videos around Boeing with comments like, hey, you bought into Boeing at $300 per share, now it's sitting at $200 per share. You could have just waited, but now you have a 30% loss. And then that's usually followed up by another question where someone else asks, did you sell your Boeing stock here at a 30% loss? And really, it saddens me to see comments like this because it shows how short-minded people are and how the concept of buying stocks on the way down to dollar cost average or cost basis lower isn't something that they've considered, or maybe they have considered it, but they don't think that it's a strategy that actually works over the long term. So if you left these comments or this sounds like you and these are questions that you ask others, listen up. When I buy a stock, I buy it in chunks, meaning I keep averaging into that position. And this leads me to mistake number 3. For me, I personally hope that when I buy into a stock, it continues trending lower in the short term because it helps me build out a great cost basis on a great company. Over the long term, what this will result in is amplified gains because I lowered my cost basis and now the stock price moved much higher than when I bought into it. So I get an even larger gain than I initially expected. So for Boeing, for example, when I bought it in at around $300 per share and now it's at $200 per share, I hoped that the stock would drop as I bought in. Now, of course, I didn't expect it to drop this drastically, especially this quickly. But as a long-term investor, guys, this is a gift. I'm able to buy into this business at even cheaper valuations than when I initially started buying in. And based on my analysis, the company is actually in a better position today than it was when I started buying in, with things like the FAA certification coming sooner than expected. So I'm actually even more bullish on Boeing today at these lower prices. The last thing I would do is sell the stock at a 30% loss, lock in those losses, wait for it to go back up, and buy back in at over $300 per share. That absolutely makes no sense to me, because why would I overpay for something when I can get a cheaper price for it right now? So I hope this clears it up. I hope you guys understand that when I buy into stocks, I don't expect it to start rallying right away. I typically expect them to drop even lower so I can average into them, have a lower cost basis, and then over time, I expect that stock to rebound and move much higher. So next time you want to leave a comment like, oh, you're down 30% of your position, just remember that's exactly what I want, because I can average in at a better price on that position. I try to do as much research as possible before buying into a stock so that when it drops lower, I'm able to average in without any worries, and I'm able to take advantage of those cheaper prices. And will I catch the bottom with this strategy? Probably not, and my cost basis will probably not be at the bottom, especially if I'm buying as we go lower. But depending on how much money I deploy and how big I build that position, I definitely can get my cost basis lower than when I initially started buying in if the stock drops lower. The next common mistake is actually the opposite of mistake number 3. I know it's tempting as a long-term investor when a stock drops 30% in a short period of time to want to buy into that ASAP. Naturally, if it's a great business, fundamentals haven't really changed, but the stock has dropped significantly because the overall market has gone down, you want to deploy your cash and you want to deploy it quick. And sometimes this can work out, especially if it's kind of a short-term blip. Maybe it's an individual stock that's dropped, but the market is still kind of relatively flat or moving higher. You see a stock drop maybe for a few days, few weeks, few months. You buy in and then it starts recovering pretty quick. But more often than not, that does not happen, especially when the overall market is moving lower. One thing that I've seen pretty often is a stock price drops, investors deploy 100% of their cash in, only to find the stock price drop even more in the next few days or weeks. So if that sounds like you, then you need to listen closely here. You need to pace your buys, and you need to actually average into your positions over time. Dollar cost average, buy in intervals, buy over a set period of time, and build out your position that way. Maybe a stock drops from $70 to $50, but you don't get the absolute bottom at 50. You start averaging in at 50, it starts moving higher, you get more at 52, 55, maybe 60, and your overall cost basis ends up being around 55. That's still the strategy that I personally would stick with, because alternatively what could have happened was that it came down to 50, you bought in at 50, and then it started moving lower to 45, 40, 30. And if you deployed all your cash when it first dropped to 50, you'd have nothing left to average down even lower. Some cases it works out that you lower your cost basis. Some cases it works out that you keep your cost basis relatively the same. And in some cases, you may increase your cost basis as you continue buying in with the dollar cost averaging strategy. But in the end, in my opinion, that is the best strategy, especially for long-term investors. It takes a lot of time and patience to not go in and buy all the stocks that you can, deploy all your cash when you see the first sign of a market correction or a crash. And trust me, I've been guilty of this as well in the past. But this time around, I'm actually pacing myself. I have gone a bit heavy so far, but I still have a lot of cash ready to deploy, and I will be deploying it over a set period of time, just in case the market moves lower and I can get these stocks at even cheaper prices. So this is a very common mistake I see a lot of beginner investors do, which is they check their account balance, their portfolio balance every few minutes, especially when the market is dropping. Now, I'm also definitely guilty of this. I find it pretty interesting to kind of follow stock charts, see where prices are on a regular basis. But I've kind of gotten to the point now where, 1,000 points swing up or down is more or less meaningless to me in the short term, because I don't care about what happens in the next few days or weeks. I care about what happens in the next 5 or 10 years. But now for new investors, see their accounts swing up 1,000, down 1,000, go into the green, go into the red on a regular basis with the volatility we're seeing right now. It definitely will play on their emotions, and it may result in them actually selling at a loss, cutting out, leaving the market and just saying, you know what, this isn't for me, this is too volatile, I don't want to do this anymore. Usually what happens is you'll see this volatility and you'll see a lot of the other mistakes we discussed in this video being made, with emotions coming into play, selling at a loss, waiting for a bottom. All these things come into play, and these investors typically end up losing over time. So the best thing that you could do during these times is to uninstall your brokerage app and just move on with your day. Keep your mind occupied, do things like, watch more YouTube videos, do things like go for a run, go play some sports. Just keep your mind occupied so that you're not focused on checking your stock balance. I guarantee you by doing this, you will reduce the stress level in your life. You'll be able to enjoy life, and you won't be focused on what the markets are doing on a day-to-day basis to the point where your mental health is actually getting affected. Remember, the end goal for investing is to really have freedom, to enjoy life, and to not worry about money. But if by investing you feel that you're stressed, you're worried about money, you're worried about losing money, and all these kind of things, then you either need to adjust your risk tolerance, maybe put less money into the market so that you're not as emotional with the fluctuations, or maybe stock market investing is just not for you and you should look at other forms of investing like real estate, which isn't typically as volatile and you don't see your money physically move on a day-to-day basis. But either way, I really hope that this video with these 5 mistakes kind of speaks volumes to you and you've learned at least one thing from what I discussed here today. Again, I'd like to thank our subscriber Scott for this video suggestion. I think it's going to be one that's going to help a ton of you out there. And if it does, guys, let me know in the comment section down below, because my goal with these kind of videos is to help bring some sort of peace and stability during volatile times like this. Guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.